Welcome, everybody. Thank you so much for joining us. My name is Stephanie Lucas. I am the founder and CEO of the Annuity Consultants and creator of the Heart-Centered Planning series. So we're very excited to bring you this content today. But before we get started, just a couple of housekeeping tips. I would love for you guys to interact with us with questions. So as Joe is presenting, please feel free to pop your questions in the panel. It's probably to your right side, but who knows? You know where it's at. So go ahead and put your questions in. I will be reading them throughout. And then, of course, while Joe is presenting, if I have my own questions, I will be asking him, and hopefully there are things that you were wondering about as well. So without further ado, I will introduce Joe Eppy. He is the founder, president, and chief visionary officer of the Eppy Group. To know Joe is to know his passion. You can tell in an instant that he is truly loves what he does. For him, it's blurred lines between work and play. With an academic background in accounting, Joe has been in the financial services industry in South Florida region since 1993. Since then, Joe has grown the Eppy Group into one of the premier financial firms in the area. Joe is privileged and honored to have his wife as his business partner and both his sons in the practice, propelling the firm into the next generation. He believes that change is a constant and keeps his hot eye on ever-changing economic and product environment. Joe manages many facets of financial planning, such as retirement maximization, tax minimization, and estate analysis and strategy, business, individual, special needs planning, and philanthropic fundraising through charitable trusts. Wow, you do a lot of things. So you have a great team.
I'm starting to slow down. I just hit 60 a couple weeks ago, and fortunately, as you mentioned, I have two sons in the business, so they're doing a nice job of picking up the slack on the philanthropy and stuff. And I've been traveling around in my motorhome, trying to chill a little bit.
Yeah, and actually, I had a great time meeting with you and your lovely wife here in Austin not too long ago. So lots of cool adventures happening in your lives right now. And really, that's thanks to the pandemic. It helped you really shift the way that you're doing things. So it's very awesome.
Yeah, no, I've been actually encouraging most agents to take advantage of the pandemic and get their business to be virtual. I was about 70% Zoom pre-COVID, and so now, we're at 100%. And even my staff now works from home.
Yeah.
Everybody's got freedom.
Yeah, I've been encouraging people to do this as well for many years. I've been doing it for about 15, so I know exactly how it goes. So, all right. So without further ado, would you like to get started with the presentation here? All right, awesome.
Absolutely.
Yeah.
Absolutely. So this is a technique that can make a lot of money on a case because you can't do this without having a large case. Ideally, you want candidates that are 10 million of net worth and above, but it works at, at 5 or 4.
Sure.
It's just smaller numbers. It's the same exact concept. So, oops, that's slide, not advance it. Slide show. From the beginning. Okay.
Yeah. Oh no, it looks like it is not going into slideshow mode.
That's all right. I can just, oh, really? There we go. Okay. The 2017 tax bill created, and Jobs Act created 5 planning windows, and I call them planning windows because they're going to slam shut.
Right.
We don't think they'll slam shut this year because even if they could before the end of the year rip out the tax bill, they couldn't retro an estate tax bill back to the beginning of the year, be an accounting impossibility. But it could get ripped out next year in 2022. And then it would be, if it gets ripped out next year, it would be January of 23. We also have an election in 2022. And the way things are looking, it looks like after 2022's election, we're going to have another stalemate for another couple of years. So these windows have to be taken advantage of. I encourage my clients to take advantage of them before 12/31. And they've already made the first move when you hear the conversations today about stepped up basis and wanting to take that away from people because the wealthy could buy a building, when a long time ago at 100,000, it could be worth 10 million today. And the government thought by having the heirs inherited 10 million, they'd get a lot of estate taxes. Well, estate taxes has always been a nuisance tax for not doing your planning. So if you do your planning, we can plan around as much estate taxes as you have. And so what happens is if I inherit that building at $10 million, I can sell it and I don't have a gain. And therefore I'm not paying any capital gains or ordinary income due to that. So at the end of the day, that's been a real issue. The 5 planning windows are very simple. One is estate tax protection into perpetuity. And the reason I say into perpetuity is once it's over the line, it's over the line. So if you get your planning done and they lower the estate tax limit to 5 million a person, then you're still good. So they don't retro anything back. The issue is when I came in the business many years ago, like 30 years ago, it was 675,000 you could pass per person. So I don't think it's going to get lowered that low, but who knows, right?
You never know.
The next thing, as everybody sees, we live in a very litigious society. So having creditor protection into perpetuity for you and your future generations is absolutely invaluable. I call it being O.J. Simpson proof. You may remember that case. He lost a $24 million lawsuit. It's a lot more than that because of interest and stuff. They haven't collected a dime, and they won't collect a dime because all his assets are asset protected. So everybody wants to be that, so that if you lose a lawsuit, besides lawyers take cases that they can collect on. They don't care about winning or losing. They care about getting paid. So if a lawyer sees he's not going to get paid, they're not interested. Income tax protection. For the eldest generation that you're planning for, you're going to get some protection and more for subsequent generations into perpetuity. And one of the big things that you need to get your clients to think about today is income taxes. This is the big risk to all of us. We're at historical lows for taxes. We're at record debts and deficits. So clearly, I haven't talked to anybody lately that thinks taxes are not going up in a substantial way for income taxes. For future generations, you can actually eliminate all income taxes. That's assuming they don't have any ordinary income from a job. But you can, from their investment assets and all that stuff, you can eliminate all future income taxes if proper plan. You can leverage wealth to the next generation in greater amounts every time the Slinky goes down the stairs. And if your clients are charitable, you can leverage it to charity with greater amounts as we go down the Slinky. If any of you ever played with a Slinky as it goes down the steps, it just gets more and more and more powerful. So obviously we call this the Slinky Technique. And as I said, they get momentum as they go downhill. And again, if people have less assets, this technique still works the same way. All benefits get larger and larger with each generational step down. So it's pretty powerful. When we get into an example in the end, you'll be able to see the real power of this. So with all money, when we use it, when we consume it for things, it's spent one of two ways, either taxable or tax-free. So with tax-free dollars, you get to use all your money. And when I ask people that rhetorical question, would you rather use 100 cents of every dollar or give 25 cents to the government, only use 75%? They laugh and say, of course, I want to use 100%. Taxable dollars, obviously, we spend less than 100%. We're giving up capital gains, ordinary income tax, alternative minimum tax, sales tax, is on top of spending. The problem with spending any money, taxable or tax-free, is that it's gone. And not only is it gone, but the opportunity to ever use it again is gone. And this is exactly what the government wants because they're broke, okay? And at the end of the day, when the government's broke, they want you to pay as much tax as possible. My degree's in accounting. When I was in accounting school, they said compound interest was the greatest thing since sliced bread. No, it's not. Because in a non-qualified, a taxable environment, I am compounding taxes when I compound interest. Where if I swept that dollar of interest into something that was never taxed again, like a municipal bond, The next year, my taxes are still $1 and they're not 25 cents higher from making an extra dollar or whatever. So taxes, you never want to compound your taxes. You always want to minimize your taxes. You don't want to have tax evasion where you go to prison. You want legal tax avoidance. And our government is so broke that Social Security will always remain as a supplement. It was never meant to fully retire us. And should you die or should your clients die, the government's not going to take care of their families for them. It's just not happening because the government's broke. And like I said, every time you make $1, spend $1, they want you to use it one time, go back, have to recreate capital again, pay income taxes again before you have access to the money. So very important that people understand taxation. And they need to use $1 one time and go back, recreate the money, as I just said. It doesn't have to work this way, right? At the end of the day, it doesn't have to work this way. And that's what we try to teach clients. It's all about education at the end of the day, right? We want to empower clients to make good decisions, because when they make good decisions with thoughtful time and their brain power, which they still have today, it comes to a much better decision. I was just saying to Stephanie before the call that there's a whole art of the way the mind works when they're buying something. So first of all, people consume from people who they feel similar to. It makes them like them and trust them. It's also how they pick their friends, and it's also, if you're in a hiring role, how you pick how you hire. So having those skills are very, very, very important to have the bonding and rapport skills. In addition to that, the brain has an emotional side and a logical side. And when I was a young agent, I needed to make a living. It was a career change. I was a career changer, and I needed to make money right away. And so I would always attempt to close people when they were still on the emotional side of their brain, and that did not work out too well. So today I literally tell my clients, I'm going to slow you down until the logical side of your brain comes back into play so we get a good decision. So what do we spend our money on? Consumables and collectibles, right? A consumable is a bill, a vacation, a tax. The money's gone and the opportunity to ever use it again is gone. A collectible is something that the money is not gone and we hope it grows in value. Stocks, real estate, businesses. That's not always true, but that's what we hope to have. So with collectibles, again, we got to go, we don't have to go back and create more money, but if we wanted to use that same money for something else, we got to liquidate it, okay? So it's very important that people understand at the end of the day how this money is working and the fact that we become this net cash flow society. And what do I mean by net cash flow? It's net of taxes, right? I call the gross paycheck the fairy tale number and the net check the real number, because that's what you can spend. So it doesn't matter what the IRA is worth, right? It doesn't matter what the house is worth, the business is worth. It matters what that asset ultimately leads to you in a cash flow net of taxes. Does it go up to maintain inflation and the cost of living? And does it last as long as you last on earth? Your clients are not going to care where it's coming from. So when it comes to cash flow, we only have 3 choices for cash flow that's created on our model, right? And those 3 choices are very simple. Oops, let me go back. So those 3 choices are very simple. You can reinvest it, right? You can put it right back reinvest the same investment. I can invest it somewhere else, or I can spend it. It's the same thing if you make a nickel of interest on a savings account today. First, we know your client has a large savings account because they made a nickel of interest and there's no interest today, but they either spend it, put it back in savings, or spend it, put it somewhere else. That's all there is. So we're all identical when it comes to this cash flow. When it comes to our income, we only have 3 choices. So I'll ask people right up front, whether someone's on a W-2 or a 1099. Most people are on W-2s. The only difference with a 1099 is the timing on taxes. But when someone tells me on their W-2, they're on a W-2, I'm going to ask them, Has your employer ever forgot to take the taxes out before they gave you your paycheck? And they laugh and say, of course not. And I ask them, do they know why that is? And everybody goes, no, why is that? I say it's because it would be considered felony theft of the federal government, and they don't think they'd look good in one of those orange jumpsuits. And it's their money. It's your money, not theirs. So they don't give a crap about it. They're going to take it out of your check and give it to the government. So that's the first bucket our money goes into before it even comes home. And then it goes into our checking accounts, mostly by direct deposit, and we use that to pay our bills. And anything left over goes to some form of savings and investments. Either it's zapped to the 401k before you got paid, it sits in checking after it comes home, you move it to savings, you invest it somewhere else. But at the end of the day, since the origin of income, everybody is allocated 100% of their cash flow at all times. And I hope that makes sense to all of you, because this is pretty much the premise that all planning works off of. And you're going to see in a minute why the CFP version of this doesn't work, right? They'll ask the same questions we're going to ask up front of a client: assets, liabilities, income, expenses, and goals. And here's how we part ways is on the solutions, right? So income has 3 places it can go. Cash flow in your model has 3 places it can go. So I don't care how much you've made, how little you've made, how much you put away, how little you put away. All we have is reallocation. If I said to a client, I need $10 more a month, $10 more a month to $10 more a month to solve all your goals, it's got to come from somewhere the client's already parking $1. Nobody has any extra. I don't care if you're Warren Buffett or Gates or any of these guys or us. We all allocate all our cash flow at all times. Okay, so that's a major preface of planning, and nobody has any extra. Okay, so as we said, you got 3 choices with it on your model: reinvest it back in the same asset, invest in a different asset, or spend it. So it means we're all identical, right? If a person has money in bucket A, they can move it to bucket B. That's reallocation. If they have, if they're saving to their 401k at work, they can decide to pay if it's pre-tax, they can decide to pay the tax on it, bring it home, and put that same money somewhere else, right? And here's where we have a huge problem with certified financial planners. And I have a lot of friends that are certified financial planners. So don't get me wrong, that they do as good as they've been trained. We all do as well as we're educated and trained. And they come from a place of great intention because I know them well. But they've been duped in their training, because a CFP is going to go back and figure out how much more money you need to put away. This one's got, oh gosh, I got to get into that thing because it's.
Yeah, that's if you have the slideshow not working.
Yeah, I know. Let me see if I go to this slideshow. You know what? Let
What if we go to File?
me stop screen sharing for just 1 second.
Okay.
Okay, and let me see when I'm off screen sharing. It's in a read-only format. That's the problem. Okay, well, we'll just work around it. No problem. Sorry for the technical difficulties.
I should tell you, like, if you click on screen sharing, you should be able to just start it. I don't understand why it's not starting.
Okay, now let me try it again. It's because it's a read-only version.
Oh, no.
All right, so again, here's where we're different than the CFPs, right? A CFP is going to come back to a client and say, look, you need to put $10,000 more a year away at 5% average return on the way in and 4% average on the way out, and you're going to be fine. Well, we just agreed the more part is physically impossible. Physically impossible. So that's the first fallacy, mathematically. Here's the second fallacy, is averages. If a client gives us $1 today and we double it, the client has $2 and they're up 100%. If they lose 50% of the investment in year 2 and 50% of the investment in year 3, that adds up to 0. divided by 3 is still 0. So legitimately, the mathematical average is 0 because math doesn't lie at the end of the day. Math just does not lie. However, the money went from $1 to 2, back to $1, down to 50 cents. So in that same time frame, they're saying they had a 0% average rate of return. Your real rate of return was negative 50%. So all those certified financial plans after 2007 and 2008 are not off an inch, they're off 100 miles, and there's no do-overs. You do not get to the end of this and say, you know what, at the end of the day, I don't like how this came out. Let me do this all over again, right? So we have one chance to get this right, and all we have are these reallocation opportunities. And if you can get the client to understand that on the front side, they're going to be very happy, okay? So as I said, can't put more away. You can't have average interest rates, right? All right.
So I have your slides if you want me to do the screen sharing.
Yeah, that'd be awesome.
All right, let me do that.
That would be awesome.
Give me 1 second. I'm going to pull it up before I.
Let me stop screen sharing.
Is that the slide you're on?
No, we're on 13. We're on 13.
Okay. Yeah, we're on 13.
Okay. Yeah. Okay. So all we can consume again is net after cash flow, right? And yeah, keep going. Going through the slides.
Oh no.
Not working there either, huh?
There we go.
Nope, same slide.
It's just so bizarre that like we can't.
Yeah. You know what? I can work through it. Let me just go back.
I'm giving you control of my keyboard and mouse, so you can actually do the screen, change the screen now. Did that work?
Nope.
Darn it.
Let me go back to my screen sharing. Hold on.
Yeah. I should have figured this out before. There's always some fun difficulties when it comes to these things.
All right. So
sorry, everybody.
No problem. Here we go. We're gonna get this moving. Okay. We just talked about this one. Interest rates versus averages, real versus average, right? Money never lies, but liars find a way to lie every day with math, right? But math will never lie by itself. It's always going to give you pure numbers. And with planning, all that can be done is make the best use of 100% of your client's cash flow and assets. When the person reaches when they want to stop everything and they're not where they want to be financially, they have really simple choices. Work longer, retire on less, some combination thereof, because the math will never lie on its own. Okay, so let's talk about why people save money. They save money for various reasons. They save it for financial independence is a big one. They save it for retirement, raising a family, education, real estate, buying a business, to invest in the stock market. Here comes a train. And the money is not necessary to maintain their current lifestyle, right? So what they get to do is they get to be financial independence. That train go by very quick. There we go. When you're at financial independence, that's that point in your life you get to work if you choose to, not because you have to. And sometimes, even though we want to keep working, our health doesn't let us work. So everybody should be striving for financial independence. And when you think about it, it's really why people work. If you ask people why they work, well, I got to pay my bills or whatever. But that's really not why they're working, just to pay their bills. That's just an exercise like spinning the wheel. So they're really working so one day they can retire, right? I don't know too many people that love their job so much that they would keep doing it, other than maybe this industry. or a couple other industries that they want to keep doing it after they don't need to anymore. So that's why people save money. So when we're saving money, where do we save it? Well, we obviously got to save it in some savings conduit, and we got to use some growth vehicle to get there, right? Oops. About that. And we got to use some growth vehicle to get there, right? So how do we do that? Because growth investments are critical to the success of investing. The key is to never come out of the asset at the wrong time. So that's why it's imperative to have liquidity on the front and back end of your savings. And let me give you a quick example of this. I buy a piece of real estate in 2008, and I buy it right. And now when we have the next real estate crash in a couple of years, I want to buy a new piece of real estate, but I don't want to sell the 2008 rental property because I'm in it right from the start, and now it's worth less, and I've got a good rental factor on it. So this is why you don't ever want to be forced to have to sell that first rental property to buy the next one. So we want liquidity on both ends of our savings accounts, no matter where we're saving money. The other features that we definitely want to our savings account is creditor protection. Like we talked about before, being O.J. Simpson proof is really, really important. When we spend the money, if you ask people if they want it taxable or tax-free, everybody tells me they want it tax-free. How about having your savings conduit meet your minimum goals, all your financial goals, if none of these other opportunities we talked about come up? And how about while it's growing? Would we like to have it grow without giving Uncle Sam a gift every year? Of course we would, because I'd rather leave a whole dollar in there growing for me and compounding than leave 75 cents in there. And how about reusing the same money, meaning that you take 50 grand out of this savings conduit and use it to pay cash for a car. And 5 years later, you sell the car for $10,000 and use that to go on vacation. And now you can take $60,000 out of the same account that you took 50 out of before, and you're no worse off because the bank said you've been such a good customer. When you take money out, we'll keep paying you interest just like you never, ever removed it from the bank. And then this savings conduit could also take care of your heirs with large tax-free gifts at the end of the day. So, anybody know what I just described?
I think it might be down at the bottom of your screen.
Oh, there it is, because that was supposed to come up automatically. There you go. It's whole life insurance, okay? And it's whole life insurance from a mutual company.
Yeah.
And in the big players, you got 4 left: Mass Mutual, New York Life, Guardian, and Northwestern Mutual. And of those 4 carriers, only 2 of them work the right way when you borrow from them. And that's Mass Mutual and New York Life. When you borrow from Mass Mutual and New York Life policies, they just give you the money and attach a lien to your account value and your death benefit. And they take the money from their general operating portfolio because you're an owner in the company as a policyholder. So your money never leaves your policy and it keeps growing like you never took it out. And that's why it's the savings account that keeps paying you interest when you use the money. The dividend performance does not change. Okay, no other contract has ever worked this way, and there's a really, really good chance no other contract ever will. Life insurance is backed by 7702 of the IRS tax code, and they just made some adjustments on the rates on it. But it'll never disappear from the code because it says death benefits are tax-free, and the inside buildup is tax deferred. And on top of that, the loans are never income, so they're not taxable. So it's removable on a tax-free basis and more than once. The 8,000 section of the code backs up the life insurance carriers. They're allowed to buy corporate bonds, which obviously pay a higher interest rate than municipal bonds. And they set that money into a reserve account for future death claims. And therefore, there's an offsetting expense. So they don't pay taxes on corporate bonds. Nobody else can function that way other than insurance companies. And this stuff's been in the code since 1913, and it's not going to leave the code. It's been there ever since the code was written. And all because the government's broke. So the front and back side liquidity comes obviously from borrowing from the whole life policy, and it's the key to not liquidating something at the wrong time, right? And lets you jump on your next opportunity. But when you really think about this in technical terms, that when you're consuming money during retirement, hey, we're concerned about longevity of those cash flows, and we need to make sure that taxation is not going to take that cash flow below what they actually need to consume, and that if they take more because taxation took it, below what they needed, or there was heavier inflation than they anticipated, then they run the risk of running out of money altogether because they'll start invading corporates, and that's obviously bad, right? This is just the example that I gave you earlier about the real estate, right? So that what it really does is give you tremendous opportunity to really take your time in making good decisions, because you always have liquidity, and that's the key. Cash is king today. I've seen a lot of great businesses fail because there was not enough cash coming in to cover the expenses going out, even though the business was extremely successful. It was just a cash flow interest. Okay. So death benefits, as I said, is tax-free. And we talked about why it won't leave the code. And again, we've got to really focus the client in on that the government really wants them to pay tax every time they make a dollar, spend a dollar, use it one time, go back, recreate capital, and pay tax on it again. Let me give you another example of this, how it works. So let's say I bought 2 properties, each for $100,000. They were identical. I bought 2 twin houses. They're both worth $100,000. And one I pay cash 100, and one I mortgage the entire 100. Okay, and I do an interest-only mortgage. So all I'm paying the bank all along is interest. Okay. So 20 years later, I sell both properties for $300,000. So in the example where I paid cash, I get my 300,000, the whole 300,000. 200,000 of that is a profit. The original 100 is the 100 I put in 20 years before. Well, 120 years before is not worth 100 today. It is actually depreciated. So in real estate, down payment actually depreciates. The real estate appreciates, but down payment is depreciating, right? So with whole life insurance, you just want to get it. It's like paying tag as a kid. When you're at home base, you're safe. First place it goes is whole life insurance. Then use it for whatever you want to work. Use it for. When we get into the Slinky, I'll get much more specific about the amazing uses and how this works in reality, right? So, case example, here we go. Okay. Anybody have any questions on any of this before we actually get into a real case example and try to bring this home for you of how it all really comes together? Anybody?
I have a question.
Yes.
Is there a way that we can use qualified funds to do this?
So the danger with qualified funds is that you're putting a death benefit inside a tax, a pre-tax asset. So that death benefit, which is the bigger number, is going to come out taxable. Now, there is a technique where we do put whole life inside qualified plans, and then we eventually purchase it out for the cash value. And so we do a substitute asset, right? So if the cash value is $250,000, I just simply buy it out of the plan put $250,000 of cash in, and I can take that policy out, and there's no tax. So you definitely don't want to die with it in the plan, but There is a way to do it if that's where all the money is.
Yeah, I'm just thinking that, because taxes will definitely be going up in the future. I mean, it's inevitable, right? That, if somebody has a very large account now and they want to do that to minimize their taxation, I
Correct.
know
We have a
it's
technique we
complicated a
use
little
there
bit.
very specifically on the retirement accounts. If someone says, I'm being forced to take minimum distributions, but I don't really need them,
Yeah,
that's a prime candidate for it. And really what they're concerned about is leaving as much as possible to their heirs. And the worst thing you can leave to your heirs is a qualified account, because A, they're gonna have to pay income tax to get at the money, and taxes are going up. B, they've just changed the rules last year. You used to be able to do a stretch and take it over your lifetime, which was very beneficial.
yeah,
Now it's 10 years maximum. So they're really forcing it out quickly. And so, the qualified plan is kind of the worst asset to leave to someone. So when someone says, I'll ask them if they'd rather leave an after-tax asset. And they said, well, of course. So what you do is you just take larger distributions out of the retirement account, you pay the tax on it, you take the net distribution and you leverage it to guaranteed universal life. You don't use whole life here, use universal life, because all we're after here is the largest death benefit. So you want to, guaranteed the 100 or 115 universal life policy, and you just buy the maximum amount. Typically, if the client's healthy, you're going to see death benefits pretty close to double or more, depending on health and age, of the IRA. And that's coming to their heirs tax-free. So yeah, anytime you've got assets that are exposed to taxation, there is some legitimate ways to plan around taxation. And I have to tell you, most people have most of their money in qualified. And the
yeah.
reason for that is it's for savings. It's out of sight, out of mind. We're creatures of habit, of spending. We're trained to spend. They spend $5 million now for a 30-second commercial on the Super Bowl. They wouldn't do that if it didn't get us to spend money, right? Buy now, same as cash, 90 days, 5 years, right? So they're trying to get us to spend, 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 spend. The country's kind of waking up. Credit card debt's at like record lows right now, record lows. And
That's
the
amazing.
bank and the banks don't like it at all.
Sure.
They don't like it.
There are a lot
They,
of things shifting in our society right now.
yep.
Yeah.
So this is a married couple that I have, Steve and Renee. They're both 72 currently, and they're living in New York as their state of domicile. And they have a net worth around $35 million. Steve had a very successful career, interesting on the IT side for several large firms in our industry. He was at JP Morgan Chase, and then he went to MetLife for years, and then his last bit was for a property and casualty company out of Australia, but always on the technical side. So he's got a lot of pensions and deferred comp. The deferred comp had 10 to 15-year payouts. We got about 4 years left on some and 9 left on others. So they all end pretty much in the next 7 to 10 years. Okay. Okay, some more case facts. Oops, that's the same slide. Wait, I go to the next slide. Okay. We set up an irrevocable trust for Steve when the estate tax limit was $5.2 million per person, and we claimed his lifetime exemption and filed that on his tax return, on a separate gift tax return. And they gift $210,000 per year to the trust. And they can do that because you can give 15,000 per person per year. So as a couple, they can give 30,000, and they can give it to as many beneficiaries as they want, but they're giving it to 7 beneficiaries. They're 3 adult children and their 4 grandchildren. Okay. And we put a $210,000, ironically, same amount, life insurance premium on Steve's life, and it's a legacy 100. It's a pay to 100 because we expect to have the cash flow in there to keep paying premiums as long as he's alive. And the 5.2 million was put strictly into the market. Today it's worth about 7.4, and there's about $1 million of cash value in that policy. And The beneficiaries of that trust, primary is his wife, and then his adult children, and then his grandchildren, and then future generations. So it's set up as a dynasty. Okay. A couple years ago, they pushed the estate tax limit up to $11 million. And when they did that, we could put $600 million more in his trust. So we did that. And we took the 600,000 a year for 10 years and bought 10 pay whole life policies. This is a whole life policy. You pay premiums for 10 years. You couldn't pay another dime in, but not pay another dime in if you wanted to. So we knew they would be all paid up with the money we had set aside. And we did that on his 3 adult children and on his 4 grandchildren. So now we're creating the next 2 runs down the Slinky. Okay. Now, in addition, 2 years ago when we started moving the 6 million, we set up a second trust. Now, with trust, you got to be very careful. There's something called a reciprocal trust, which means they're basically set up for the same purpose for a husband and wife at the same time with the same kind of assets. And that's considered a scam to the IRS, and everything would be considered still part of your estate. But when it's done properly, a couple can have all their assets outside their estate and not lose access, use, or control. And as long as you have life insurance on each spouse in their trust, if one spouse dies before, one spouse will die before the other, there would be another, several $1 million dumped into that trust. So then they have even more cash to work with, and it's still outside of the taxable estate. So we set up a second trust for Renee, and we put a $2 million guaranteed UL policy in there. Again, we were not looking for cash value. We were only looking for death benefit. So we wanted as much death benefit as we could buy. And I think it was like $60,000 a year to buy $2 million of UL guarantee. And she was like 70 at the time. Now, to help out their family, they do that a lot. $60K for grandchildren, summer camp, private schools, big family trips, future college funding, their own retirement, help with down payments for kids on houses, and everybody. So when the deferred comp ends, any income shortfalls that Steve will have will be made up from the whole life insurance that's in the trust. Okay. And the nice thing is that anytime anybody in that family needs a consumable, that bill, that vacation, the tax, they're going to borrow from the whole life policy tax-free, and it will replace itself. So they'll pay no tax on their disposable expenditures, which is what you want. When they get an opportunity to invest, real estate, a business, stock market, whatever it is, flipping houses, they simply invest in the whole life. They simply borrow from the whole life insurance inside that creditor protected irrevocable trust and put the money into that vehicle. Now let's assume the business was a risky business and it fails. Doesn't matter, the whole life will recreate that money over time. It'd be better if it didn't fail, right? But they never have to pay that loan back. The way we structure these policies, everything keeps growing, dividend, cash value, death benefit, without paying a dime back of interest or principal. Because of the way dividends work, and conversation for a whole nother day. But Steve has been using cash for all this stuff because he's got a lot of cash, because his income right now is about $1.5 million a year. And so he's got a ton of cash coming in, and he goes, well, I got cash sitting. I go, Steve, you got to touch base with it first. It's got to get to the whole life policy first. Then borrow it from there to pay for summer camp, schooling, whatever you want, right? But don't use your cash first. Get it over there first, where it's in a creditor protected, and plus it's earning. These whole life companies are paying, anywhere from 4.8 to 6% dividends right now, and those are tax free. Okay. So we don't want to use anything other than the best place, right? And after we get into the whole life, then use it however you want. You know, people say, "Oh, I love doing real estate." Fine, I'm not telling you not to do what you love to do. Just get your money where it's safe and earning properly first, and then go about your business.
So we had a question come in if you want to, before.
Sure.
So Jerry asked, do a lot of clients buy into this concept? So I know at the beginning you said what type of client. So what was it again? What's their typical net
Well,
worth?
so typically you want to find people with 10 million net worth or above,
Okay.
but it works at 5 million. The numbers are just smaller, and I'm going to show you numbers soon. I would say that do most clients buy into it? It depends in your presentation. I learned a long time ago never to mention the words annuity, whole life insurance, because the client's ears close. So what I do with a client is in an opening appointment, I am getting them to see my spreadsheet, and I'll show you that real quickly at the end. But I'm going to get them to see my spreadsheet. And once they see my spreadsheet, which is just a financial simulator, they want their stuff in the financial simulator because it gives them year by year by year cash flows, and they're going to see how it comes out. Because all we're doing the first swoop through, and if you work with me on a case, all I'm going to do on the first swoop through is populate your client's current plan, no changes. Just want to see what they're doing and make sure they understand what they're doing, because maybe they're going to like what they're doing. They don't need to change anything. That hasn't happened yet. So a lot of it is not what you say, it's how you say it.
Sure.
I will tell you that I've presented probably 15 of these cases in the last 2 years. And because, you know, they're big cases and you don't do a volume with them. And I would say of the 15, I know we wrote 8, and we didn't write 7. So, you know, it's a little over 50%. But when you realize that a lot of these cases, because I'm going to show you another piece we add in the end here, but a lot of these cases typically are around 1 million, $1.3 million, $1.4 million, $1.5 million in premium.
Sure.
Annual premium. So, you know, you don't need to close too many. If you can close 1 a year, you're happy.
Sure.
Okay. So let's talk about the results we get out of this. Okay. When Steve dies, 9 million is going to come down the Slinky. And we're going to use that all to buy insurance on the great grandchildren that'll be born by then. So we're going to get a leveraging on death benefit. So you're going to see we basically use 5 million more on insurance every generational flip. When his 3 adult children die, $40 million comes down the Slinky. Now here we'll use 15 million for insurance, which leaves 25 million. 25 million can go right into that family trust for the family to use all of it, or it can be used to fund the family foundation. So if your clients have charitable interests, we can leverage the charity as those 5 windows pointed out. When his grandchildren die, 120 million comes down the Slinky. So we use 20 million for insurance, 50 million to the trust, and 50 million to the foundation. When the great grandchildren die, it's $200 million that comes down the Slinky. You use 25 million for insurance, 87.5 for the trust, 87.5 for the family foundation. This goes on into perpetuity if you use a dynasty trust. So this is generational planning. Talk about leaving a legacy. You know, someone that's the grandfather today says, well, I'll never know my great grandchildren. Well, they'll know who the hell you are. I promise you.
Yeah.
I promise you they'll know who you are. They'll know everything about you because your legacy will go on because of how you structured it. All right. So now premium financing. Okay. If some of you are not familiar with premium financing, it's just a way to buy life insurance at about anywhere from 2 to 2.5 cents on the dollar.
And this, so I am clear and everybody else is, this concept can be brought into the scenario, or is it always used?
Yeah,
Okay.
so this is always an option whenever you're buying insurance. And so you could use this outside of the Slinky too. So premium financing is just a way to, you know, it's great for people who don't want to shed a lot of cash flow for life insurance. Maybe they're tied up in real estate. Maybe they're getting better use of their dollars in a business or in the market or whatever. They just don't want to take it out. When you see the leveraging you get, and I'll take this off a real case that I did a couple years ago. So this was a gentleman that has a airline fund where they buy used jets and lease them to the commercial airlines. And we needed $30 million of insurance, and on a 10-pay whole life, it was going to cost $1 million a year. Well, they certainly did not want to lay out $1 million a year. Interest rates a couple of years ago were ridiculously low, and through the bank that they did, ran their half a 500 or the $5 billion fund through, gave them a 1.5% interest rate. Okay.
Right.
So yeah, so the first year the bank shed $1 million, pay the premium, and they gave the bank 15,000 of them. So typically he'd pay $1 million, and if he died, the family would get 29 net because he paid $1 million to get a $30 million death benefit. But in this case, they got the same death benefit for 15,000 because the bank gets their $1 million, and the heirs get the 29 million, but now for 15,000 in premium. So we do this the first 10 years. We just pay the interest on that, and we let the bank advance the entire $10 million in this example. In the end of the 10th year, if they're very wealthy and they have 10 million in other assets out in that same trust, we're going to use that to pay off the loan. Why? We just juiced up our Slinky technique by 10 million of cash value and 10 million of death benefit.
Yeah.
If they took it out of a piece of real estate and borrowed it out, borrow it back out of the whole life and pay the loan off if you need to. But at the end of the day, what we're trying to do is get all the cash inside the whole life now, because once a whole life policy is matured like that, it's going to start paying between 4.75 to 5.25 the first year in tax-free interest, and go up every single year after that as the dividend goes up every year. So I don't know anywhere where wealthy people can get 4% net of taxes today, let alone 5, and eventually gets up towards 6. It's just unbelievable. And it's because the insurance companies have a lot of other investments and they're not just playing with interest rates. In fact, the dividends that are, 4.5 to 6% would be 12 to 14% if we had interest rate. There's just no interest rate. So when interest rates come back, they will get up to those kind of dollars. So what you're doing with premium financing, we typically do it on the top person in the Slinky, because that's the oldest person and that's going to be the highest premium, right? And so that's typically where we're using the premium financing. And what that does, obviously, is really enhances the death benefit you can do on the top side. All right. One more thing I want to cover before we open it up for questions and some of that stuff is we're talking about taxation a lot today. And one of the ways that you can get people focused in on planning is explaining them how taxation works on Social Security at retirement. Because people are so worried about their money running out during retirement today that the taxes is one of their huge concerns. Because if taxes go up, or when they go up, you lose more of your income. And maybe now you don't have the income, and again, you start evading principal and you run out of money. So a married couple today can have $36,500 of income, ordinary income, on their tax return before you have to start paying tax on Social Security. So I win bets with CPAs all the time. My clients get pre-tax money out of their 401k IRA without paying income tax on it. And they bet me $100 because they say I'm going to send my clients to prison. And I simply pull out the code that says I can have 36.5. Now I know that the standard itemized deduction today is 24 grand for 2 people. So 36.5 minus 24 is 12.5. A married couple's got to have like 19.9 of income before they pay a penny of income taxes. So now that couple owes nothing on Social Security and nothing on that 36.5. let's say it's a couple that's got 50 grand a year between the two of them in Social Security. That couple now has 86.5, over $7,000 a month to spend. I bet a lot of your clients are not using $7,000 a month to live today, right? And so people, my clients all have better incomes during retirement net of taxes than they had while they were working. Because with that ordinary income, it's hard to be able to do that, right?
Yeah.
So understanding how taxation works, I'm gonna give you a last quick example of this and we'll close with it. So my dear friend, my best friend is a surgical ophthalmologist. He's in practice with 4 other docs. They just sold the practice to a private equity group, which is the next Ponzi scheme, but conversation for another day. And they got big money for the practice. His partners would never let me work with them. And my friend Michael did everything I told him to do. So his partners have everything in qualified accounts, like most people. And they're gonna have to take 400 grand. They went 300 grand net of taxes. They're gonna have to take 400 grand out of their retirement account, plus 60 Social Security. Give Uncle Sam 160. We don't pay state or city income taxes in Florida. So therefore, he's only got to pay federal. So 160, he'll net his 300, and I'll have 25,000 a month. Michael's going to have 36.5 pre-tax 401k, no tax, 60 Social Security, no tax, 204 from Roth and whole life. He'll pay no tax. So 300 gross, 300 net.
Amazing.
So understand that you can do really good tax strategies for your clients because they got to hedge against income tax at retirement. That's the biggest issue we got to plan around today. It's not estate taxes. So, and just a couple parameters, and then we're going to throw it up for questions. Stephanie provides this stuff to brokers, obviously, that work with her. And I know the large brokerage firms do the same thing, but it's not the same. It's not the same at all. It's not the hands-on attention. It's not, if you get a case, you can do joint work because of the complexity of these cases and to keep myself out of compliance trouble. Anybody that does get a case on the Slinky technique, you will need to do it through me and through my office. Of course, it'll run through Stephanie's office. So you'll need to be, affiliated with Stephanie. But this is the first of many things she's going to bring to the table like this. And she actually reached out to me on LinkedIn. She was looking for me to, I'm sure, broker through her. And we had the most amazing conversation when she reached out to me. And so much so that I went down to Austin and actually spent a little bit of time with her because I really saw a synergy because what she does and what I do are very complementary. So for those of you that are not through Stephanie, I can tell you in my 30 years of experience, she's as good as they get, and you should take advantage of her services. And it will get you access to me on any advanced sales case that you get yourself into, because that's where my focus has been. I do have a large practice, so I have a lot of people that handle everything else. But so with that, I'll throw it open to questions.
Thank you. All right. So I know this is pretty clear, but we definitely want people to be in communication with Joe. So I will be providing a recording of the webinar with an email that I'm going to follow up with you guys in a couple of days, and I'll include Joe's contact information. And then keep an eye out for our next webinar we're going to be hosting on June 1st, and it's about the importance of an abundance mindset, and it's part of our heart-centered planning series. So it's the second one in our second season, which is super exciting. We are going to have a abundance and mindset coach, Ellen Tyler. She actually was a multiple MDRT qualifier. So she's been in the industry and she works with agents and advisors as the majority of her clients. So I think you guys are going to really enjoy that. Other than that, definitely follow us on social media at the Annuity Consultants if you aren't already, on Instagram, Facebook, LinkedIn. Where else are we? YouTube. Yeah, we have a whole lot of good stuff on YouTube. So definitely check us out there. And on Twitter, I guess with that, again, thank you guys for your time today. And Joe, thank you so much for doing this presentation. I really appreciate you. And I look forward to working with you and your team on a continued basis and bringing more people to you. So
Awesome.
you guys have a great day.
Thanks for having me. Really
Yeah.
appreciate it.
Thank you. All right. You guys take care, and we'll see you next time.